Good morning and welcome back, everyone, to our thematic investment series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about the shift that we've seen from the pandemic to working from home. And what I find very interesting about this particular topic, as me and my team dug into looking at the companies that are within this thematic investment series, when we started the research, we thought we had a pretty good idea of the type of companies that fell under this umbrella and generally what we thought of them. But as we kind of dug a little deeper and looked at all the potential cloud computing plays, we realized just how vast this group or this segment really is, or if you could call it a subsector. So today, what we're going to do is we're going to try to take a deep dive into the cloud play subsector, but also at the same time, it's almost just scratching the surface. Despite this is probably going to be one of our more extensive thematic investment series with respect to the number of companies that we dive into, the different subsectors that we dive into. I feel we are really just scratching the surface. So what I'm going to try to do is provide a pretty broad sense of just how wide the cloud computing space is, provide you with some ideas and some thoughts, some types of companies that are in this particular space, but at the same time also show you some of the peers that we didn't get a chance to cover, that we may have to come back and perhaps do even a second deeper dive into this specific subsector of the market and how cloud computing is just becoming almost universal to software infrastructure platforms across the board that we use. And the pandemic, when we talk about working from home, has simply just accelerated this trend that had already been in place for largely a decade before the pandemic. So those are some of the things we're going to discuss here today. Now, before I get started, what we're going to discuss is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So talking about some working from home trends, what we're going to show you is really the trends that what were accelerated this particular year. They have actually been in, they have actually been intact for about a decade or so. So what we really have seen is really just an acceleration to this digitization. And when we think about cloud plays, we usually think of the more traditional IT clouds, companies like Amazon Web Services, Microsoft, but there's actually far more interesting companies, in my opinion, that are in the earlier days, if you will, of shifting over to cloud computing, whether it's for specific industries like biotech, for insurance, or companies that are working on digitizing call centers, and especially as we work from home and we shift all of our spending and e-commerce to online, the expectations that consumers have come to expect from the companies that you purchase from have had to shift to cloud-based services. So what we'll do is we'll break today's session into 3 sections, and we kind of go top down, if you will. First, we start with infrastructure as a service. This is the more traditional cloud players like Amazon, Microsoft, Oracle, Google. Then we'll talk about platform as a service, taking a look at cloud players that have used the cloud to deliver a whole platform to a whole industry that specializes in a specific vertical. Then we'll talk a little bit about specific software as a service, so more specific integrations of applications that are done better in the cloud, done faster in the cloud, and more widely distributed to the general public in the cloud before we open this up for Q&A. But like I said, as we did this research on these types of companies, at first I thought it was a fairly straightforward topic, but as we started getting into the nitty gritty, we really just didn't realize how broad this cloud play was, whether we're talking about e-commerce or marketing or customer service or customer data, front office, industry specific, all of these. And we're going to try to get through as many as possible, or at least try to scratch the surface on many of these so that you can get a sense for the type of companies that are emerging using cloud as their primary um, I would say, differentiator, and giving you a sense for the other players that are in this space to hopefully expand your research into this particular subsector. But the primary thing that I want to discuss here today is really giving you a better understanding as to what are the primary investable themes in cloud computing over the next 1 to 3 years or so for longer term investors. So suitable for either if you're using the equity themselves as a long-term investment, or perhaps looking at option strategies like a leap strategy for longer term views into these types of stocks. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my team's research into the cloud computing space and the type of companies that we have found to be leaders and interesting applications of cloud computing to differentiate, accelerate, and digitize what had already existed, but is disrupting those industries by leveraging the cloud to deliver their particular services. So, like I said, before the pandemic, the trend of working from home had already started to be in play, a pretty steady trend. And what we've effectively seen is just the pandemic has accelerated the working from home trend. But the one thing that we have to recognize is that there is a very large disparity depending on the industry that you work in terms of whether or not working from home is accessible to you or not. So as we look within the cloud computing space, we have found very specific and specialized verticals that have applied cloud computing that seemingly are far better and far more efficient by using cloud computing than others. So we really want to be targeted when we're looking at specific verticals and industries that are using cloud computing. And throughout the pandemic now, 58% of all respondents to a Bank of America survey say that they prefer working from home since the pandemic. Despite the challenges that we generally have with working remote, 58% of investors, 58% of survey respondents prefer working from home. Most people say it's because of the more flexible work schedule, as well as a lower cost because we're not commuting to work. But also commuting to work is also one of the major gripes that people have with having to go into the office. So having more flexibility is certainly one of the leading causes as to why people work from home. And I'm curious, how many of you on this call today work from home? Please type 1 if you work from home since the pandemic, and please type 2 if you're still going back to the office. Okay, so I see pretty much significantly more 1s than 2s. So many of you can probably relate. Some of you may even work in industries that we're going to cover, or work for some of the companies that I'm covering. Like I said, I found this really fascinating to dive into this particular subsector and coming to a realization just how broad cloud computing is these days, and the different types of industries that are leveraging cloud to differentiate themselves that I have never even heard of before starting this research. So really excited to share with you some of this. But as we look at cloud spending, this is really where we continue to expect a fairly strong acceleration in terms of the amount of cloud spend as a factor of total spend for most IT and sales and finance professions. We expect that almost close to 90% of all spending with respect to this particular category in IT will be leveraging some type of cloud solution. Now, more so on the CRM side than the ERP side, but ERP is one of the faster growing segments of cloud computing. This is the slowest, but also the largest potential opportunity is in the enterprise management side of things. So we really want to pay attention to the different types of companies that are in this particular space. And then what we're going to do is we're going to explore the different platforms or services, if you will. Cloud communications and video conferencing is certainly one of the top ones that we'll pay attention to here. We'll also take a look at customer engagement platforms as we all shop online going forward, and as we all expect our customer service experiences to be more digital and more online. And not to mention, many of us now expect our customer service experience to be multi-channel. We want to be able to access customer service or support through text, through email, through phone, through through chat, through social media, and many companies are becoming more and more available through these multiple channels, where historically perhaps they were only available by phone or only available by email. So the cloud computing, I would say, spark that the pandemic has created has really allowed companies to accelerate their digitization of customer service and customer engagement, which has made it a lot easier for consumers to engage with the companies that we buy our products with, and at the same time has exposed some companies that are really lagging behind in this particular space. So cloud computing has become a major differentiator for consumer brands. So really interesting stuff that we've found as we dove into this. Content management, we'll talk a little bit about public cloud, which is the most obvious one, if you will, when we're talking about this particular space. E-commerce and digital commerce, we'll talk about team collaboration, we'll talk about, so there's a lot that we will take a look at here during today's session, and just giving you a sense for the priorities, if you will, of IT budgets, and what percentage of IT budgets are going towards these types of cloud services. So we're going to discuss a wide variety of subsectors. And like I said, even within that, what we're really doing is just scratching the surface and providing you a good starting point so that you can then do further research. And like I said, we'll likely come back and potentially do another second round of the series, just so that we can show you just how broad this is. So like I said, what we're going to do is we're going to start off on infrastructure as a service. Now, what I mean by that is really the cloud computing companies, or the major cloud computing companies that power all of this, at the backbone, if you will, of the cloud computing space. So Microsoft, Amazon, Oracle, Google. Looking at those specific companies, we're going to cover all of them because there's relatively few of them, and they are the top 2 or 3 really dominate the entire space. Then we'll talk about platform as a service. This is more of I would say, and this is more of an emerging, I would say, use of cloud computing, or at least companies that are differentiating themselves as cloud computing experts, or specific vertical experts that are leveraging cloud computing. These are relatively early days of some of these companies, and we'll talk a little bit about the different verticals that seemingly have applied this very well. And then lastly, we'll talk about software as a service, which is a fairly broad category and is a very, very diverse category. So there is really, we're just scratching the surface and providing you with an understanding as to the different types of companies that operate in this space, and giving you a fairly wide range, if you will, to start some more research with. So let's start with the infrastructure based companies. So the number 1 player in this particular space is going to be Amazon. And what I find really interesting about the infrastructure as a service players, meaning the huge cloud players that power everything that we're going to talk about here today. What's interesting is that pretty much every single one of the top 4 companies, cloud computing, while is a large portion of the revenues that they generate for their company, almost all of these companies do not do cloud computing exclusively. Amazon, for example, as we all know, has a very large e-commerce business, has a very large, now a very large logistics business that is actually largely funded, if you will, from the cloud computing business, which is the high margin, high growth part of their business. So Amazon is still the number one player in this particular space. They own a 40% market share of public cloud provider, which means that if you're a company and you're a startup, whether you are a small company with 2 people in it or a large enterprise company with 200,000 employees, you no longer need to run your own data centers. You effectively contract that out to Amazon. Amazon manages everything so that you and your developers just have to worry about your software. You don't have to worry about the infrastructure of managing data centers. Amazon does all of that for you. So for those of you that are not as familiar, that's really how cloud computing works. Basically, you don't have to have your own infrastructure. Amazon manages all of that for you. Now, what's interesting about Amazon is that despite being the number one player in this particular space and trading some spaces over the last few quarters with as far as whether they're continuing to gain market share or starting to lose, that market share, this is really where we continue to see Amazon Web Services accelerate their market share. So a 4% quarter-over-quarter acceleration in terms of gaining market share versus Azure, the second biggest player, decelerating by about 2%. So this is really what's I think quite interesting, is the fact that Amazon, the largest player here, still claiming some more market share from the other 2 players. They have a fairly robust service with respect to the different suites of AWS that they offer. Currently generates about $54 billion of revenue per year on this particular business, versus last year they generated about $386 billion in revenue. The rest of it came from e-commerce, but the thing to remember is that the $54 billion that they generate in terms of revenue from AWS, the margins on cloud are far, far, far greater than what they're getting on e-commerce. So whenever we look at any of these cloud players, it's interesting to see what percentage of the revenue do they generate from cloud, how high are those margins, and what are they doing with those? What are they doing with that revenue to fund other business, if you will, right? So Amazon funds their e-commerce business. They fund the expansion of their e-commerce business. They're funding now a content business. They just recently bought MGM, and also now they're a major logistics company. I think right now 2/3 of all Amazon packages are delivered by Amazon Air as opposed to FedEx and UPS. So a very, very large shift, if you will, from Amazon, from shifting their revenues from cloud services into other businesses. And that's how Amazon's been able to grow their overall pie. Versus Microsoft, which is interesting because Microsoft is actually, in my opinion, out of all of the major cloud players, really the one company that generates pretty much all of their revenue across the board in a fashion similar to their cloud computing. So their cloud computing product is Azure, which is the second largest by market share, about 25% market share of the infrastructure as a service market, if you will. And Microsoft Azure, for all intensive purposes, is the same as Amazon Web Services in terms of they manage the infrastructure. You and your team that leverages their infrastructure only has to manage the software side of things. They manage the data centers, they manage all of your hardware, and you can basically scale up and down as at the click of a mouse effectively. So if you all of a sudden need 10 times the amount of computing power that you need yesterday, you can have it immediately. You don't have to go out there and buy servers and set it up and do all of that work that you historically had to do. And it absolutely has just revolutionized the way companies expand into the software business. It powers OptionsPlay. OptionsPlay is powered by cloud services, so that we don't have to manage our own infrastructure. We simply focus our attention on building the best possible options education, options software, so that everything else is being managed by a cloud computing company like Microsoft or AWS. Now, this is really what's interesting about Microsoft, I think, is the fact that Azure is the dominant high margin business, if you will, within Microsoft. And what's interesting about Microsoft is that the other businesses, which is predominantly Windows and Office 365, they do have LinkedIn and they do have Xbox, but those account for relatively small percentages of their revenue, about 5 to 10%. But the Office 365 and the Windows are also very high margin businesses, unlike Amazon, which the e-commerce business, the logistics business is substantially lower margin. They're trying to get into higher margin businesses, but content, e-commerce, those are low margin businesses, and it's hard to expand those margins. It's really more of a market share game, right? So Amazon has to keep growing in terms of their e-commerce pie in order to grow it. Microsoft, on the other hand, I think has a fairly sizable advantage compared to Amazon from the perspective of almost all of their businesses are substantially higher margin businesses than Amazon. But none of them beat Google in terms of, or Alphabet rather, in terms of their business, because the Alphabet, largely same thing. Google Cloud, which is their version of AWS and Azure, offers a fairly similar product to AWS and Azure. There are some differences, in my opinion, in terms of what Alphabet offers in their cloud business, because they are a leader in AI on their cloud computing. They offer quite a few different products within their cloud computing workspace, TensorFlow. They also offer quantum computing now for certain companies that have very specialized needs of quantum computing power that they need. So Google's trying to differentiate themselves with their pure intellectual property that they have on cloud computing and sort of AI. And that's allowed them to grow market share, but it's still the third largest. They're at 10%. They haven't really been able to grow any market share lately. This is something that they've just managed to keep at about 10% market share. So this is really where Google, Google is the out of the top three major players, is still not generating the vast majority of their revenue, or rather, their highest margin business is not their cloud business, which is interesting for Alphabet, because their cloud business, while a high margin business, still pales in comparison to AdWords and YouTube, which generates about 2/3 of all of their revenue and is actually a higher margin business than their cloud business. It's almost like Google's the exact opposite. Instead of taking profits from their cloud businesses to fund their other businesses, they are taking the profits from AdWords and YouTube and funding their cloud business, if you will. And they're trying to grow their market share there. But like I said, Google at this point hasn't really made any headway in gaining market share or taking away market share from Amazon and Microsoft. It's really Microsoft and Amazon competing for number one and number two, trading places, if you will, in terms of how much market share they're able to gain from each other. And they're pretty much neck and neck right now, versus Google is kind of pretty much flat at about 10% market share. But I will say that there is some risk here to Alphabet as an investment, despite the fact that out of the three, I do think Google or Alphabet is the most compelling, because it is a higher margin business across the board. But I think Alphabet is coming across some issues across just how dominant they are within the advertising business, and also privacy is becoming more and more of an issue. Where Google or Alphabet largely relies on collecting a lot of data on users in order to power their ad business. And the question is, how much consumers are willing to continue to allow Google to have access to their data in order to run their business. So there are some downside risks, I think, to what I believe is actually the strongest of the three from a business model perspective when we talk about high margin cloud-based plays here. And lastly, you still have Oracle here in the mix. And Oracle is a relatively late player to this particular group, but Oracle is a company that has literally transformed themselves over the last 10 years or so. Oracle, for a while, companies were still running their own infrastructure before they migrated over to cloud were running Oracle databases. Oracle was the #1 provider of those types of services for a very long time, since about 2000 or so. But around 2012, 2013, as Amazon Web Services and Azure started to getting started, most players on AWS and Azure are running more open source databases. They're no longer using Oracle databases, which require a payment to Oracle in order to run that. So Oracle has really had their market share of infrastructure and databases erode over the past 10 years or so, and has really transformed themselves, if you will, into this new cloud business that allows them to offset the erosion that they've had from their database business. So database is now generating about 36% of their overall revenue, where it used to generate 80 to 90% of their revenue. And they're now generating about $2 billion a year from their cloud business at the moment. And they are growing fairly quickly here, but not quite the growth that I think many investors are really looking for. They have some pretty high profile clients like Zoom, Dropbox, FedEx, but outside of these few marquee clients, they haven't really been able to grow Oracle Cloud in the world of AWS, Microsoft, and Google. So it's an interesting small player to look at in terms of your portfolio. And again, they are transforming themselves and being more cloud focused. So this is something that's more of a small player that could play a little bit of catch up, a little riskier, but has potentially some larger upside than Microsoft and Amazon. So those are the four major players, or the four players that provide the backbone of all the other cloud computing companies that we're going to take a look at, or applications of cloud computing companies that we're going to take a look at here today. So the next thing I want to take a look at is what we call vertical cloud. This is really where we look at specific industries and how cloud computing has allowed the optimization of specific roles. And this is generally more so for industries that have higher regulation, many times financial services, insurance, biotech, medical companies that have just a lot more, I would say, intricacies, if you will, within the digitization of the workflow of users. That's really kind of where some of the cloud computing companies that have specialized in specific verticals have come into play. So some of these companies, or actually most of these companies, I had never heard of before doing this research here today, but it was really eye-opening just to see the different industries that are now moving over to the cloud and leveraging the cloud to effectively disrupt an industry that used to have a lot of old software. And I'm personally in the financial markets, and I see a lot of old software being used by banks, by brokerage firms, partially because of the regulation that's involved in updating software, and just the legal compliance hurdles that are involved in doing so makes change a very slow process. So there are companies that are coming in basically soup to nuts from top to bottom, and building a cloud computing platform that allows certain roles to be far more effective in their roles. So again, the higher regulatory type industries are the ones that are at the highest risk of disruption, or rather the largest opportunities. So Viva Systems is an example of one. Viva Systems works in life sciences, and life sciences is really a medical field, if you will. So this is a company that has provided a CRM software specifically for life sciences companies. So think about a biotech company that are creating medical devices, and their sales team that they need to go out to sell to hospitals, to doctors. It's a very specialized field, if you will, because of the going to market with the medical field is not the same as going to market with a new shoe. You can't just send out an email saying, hey, look at this cool new shoe and post it on Instagram and social media and get influencers to purchase your shoe. It's far more specialized in terms of how you can reach out. There's also a lot of legal and compliance around medical related products. So Viva Systems has created a CRM software that is compliant, if you will, with regulations and works with sales reps in this particular vertical that makes their lives a lot easier. And this is a relatively small company, just $1.4 billion in revenue last year, but is seeing some very strong revenue growth here, 32% year over year revenue growth. As you can see here from the underlying stock, the stock has recently found a bit of a base here between 240 and 310 or so, after what has been a large move here to the upside from about $120 or so to 240, basically doubling in the relatively short span right after the pandemic, and then has spent the last almost 9 months or almost a year or so consolidating, and is on potentially the verge of another breakout here. So technically speaking, interesting time to look at a company like Viva. It is expensive. It's trading at 26 times next year's sales. This is one of the things that you're going to discover about cloud computing companies, is that from a valuation perspective, they are all very expensive. It's almost impossible to find one that's relatively inexpensive. There are a couple that I'm going to show you, but most of them trade in this 20, 25, 15 type times next year's sales valuation, which makes it difficult, I think, for some investors to continue to chase new highs. But these are the valuations that the market is commanding for these types of high growth cloud-based companies. And this is a company that's, the growth here is interesting because, they started as a specialty in life sciences in the medical field, but they are now expanding into chemicals, into cosmetics, and also into consumer goods using their software to power CRM or customer relationship management software for these verticals. And they're doing a pretty good job of expanding internationally here as well. So that's, the opportunity, if you will. And as you can see, these are still relatively small companies doing just a few $100 million in revenue a year, or just over $1 billion in revenue, nowhere near the tens or hundreds of $billions a year of some of the large cloud players. So most of these are relatively small companies. You may not have heard of them, but this is really just giving you a sense for what's out there in the different types of verticals that these cloud computing companies are operating in. The next one is nCino. Again, a company that I've never heard of before doing this research here today, even smaller, doing about $204 million in revenue. And this is a company that does something similar to what Viva Systems provides for life sciences, but they do it for financial institutions. Now, if anyone here has ever worked in a financial institution, you know that the software around the back office, the front office applications, there's a lot of legal and compliance bureaucracy, if you will, that's involved in evolving those systems. Many times they're very kind of, I don't want to say they're not antiquated, they're just less innovative because they have to comply with different regulations. There's a lot of regulatory and compliance hurdles that software needs to jump through. It's not quite the type of move very fast and be innovative type products that you typically see in the financial institution space. So what nCino has managed to do is really focus on a few different verticals. Loan origination. This is a vertical of financial services that's very compliance heavy. Whenever you're issuing loans, there's a lot of rules and regulations around what you can and cannot present to the customer. Customer onboarding, if you think about opening an account at a brokerage firm or at a bank, there's a lot of regulations around that. The customer portals that you see for managing treasury, for asset leasing, for portfolio analysis, there's a lot of regulatory burdens around creating these types of softwares. And these are some of the things that OptionsPlay has to navigate. And part of our solution that we provide to our customers through cloud computing that allow us to leverage our expertise and deploy them to all of our customers through cloud. So similar to what OptionsPlay is doing, but for other financial institutions like mostly banks and insurance companies that they provide them with. Now, this is a company that also grows fairly strongly, 23% year-over-year revenue growth. What's interesting about this company is that it has been in a fairly significant downtrend here over the past year or so. This is a daily chart because this is a company that has not been trading for very long, but I do think that it's worth paying attention to because as the stock has declined over the past couple of years or so, it does seemingly have put in a bit of a bottoming formation here. We really would like to see a breakout here above the 108 moving average, but if it rallies back up to 72.5 and breaks out above that level, now we could say that this downtrend is over and that's likely going to continue on its way back up. And especially if you look at the quarterly revenue growth and the fact that they're accelerating their quarterly revenue growth, that is what I think is strong, or that's what I like to see for a company that's turning around from a technical perspective, where the chart is starting to turn around, where you start to see revenue start to accelerate to the upside. Similar to the other companies, it's fairly expensive, trading at 23 times next year's sales. And the reason that we're using sales multiples here is because most of these companies are not profitable. So you can't really look at earnings in order to value these types of companies, or a multiple of earnings. You could do a multiple of enterprise value to sales, or just market cap to sales. And that's really the type of valuation metrics that we're using to give you a sense. And as you can see, most of these players are in that 20, 25 range. Some of them are lower in that 18 to 19 range, but largely they're in that band of about 18 to 20 next year's sales in terms of valuations. The earnings revenue growth is going to be different. This one, 23%, is I would say fairly average versus something like Viva, which does grow a little faster at 32% year-over-year revenue growth. So those are some of the other things. Those are the two primary things that you want to factor into beyond just the fundamentals of what the company does. And lastly, Duck Creek Technologies, again, a company that I had never heard of before doing this type of research. In terms of revenue, very similar to the previous company. They do cloud provider of specifically more so for the insurance companies. They specialize in insurance companies. Everything from casualty insurance to help them automate billings, to automate claims and policy fulfillment. So if you think about companies like Lemonade, what has made Lemonade so powerful in terms of, as an insurance company over the past few years, probably the most innovative insurance company we've seen in a very long time. How has Lemonade powered that? They've powered that through what most consumers would say is a much, much better user experience of insurance versus any of the traditional insurance brokers that you would typically see, like Allstate, Geico, that operate in this particular space of renters insurance, of being able to insure individual items. Lemonade just makes it easy, and some of it is powered through cloud solutions that are created by Duck Creek Technologies. And has changed the way that insurance companies interface, if you will, with the consumer. And this goes back to what I was saying before. These trends started before the pandemic. Lemonade has been in business for many, many years before the pandemic. They were listed, if I'm not mistaken, before the pandemic. But it just shows you the different types of industries that are being disrupted based on the expectations that consumers now have with the products that they purchase. It used to be just thinking about, how can I buy my shoes a little quicker? Instead of going to the store, I can buy it online and get it shipped to me. Now we're looking into financial services. We're looking into medical fields, things that we never thought of needing to be digitized, or needing the customer experience to be shifted, if you will. There are plenty of technology companies playing in this particular space, and these are very early plays. $211 million in revenue last year is nothing in comparison to most of the companies that we look at. So the upside here for many of these companies are still huge, or they're very much in their early days of their of their starts, if you will. And if you look at Duck Creek Technologies, seemingly finding some lows here around 30, 38 or so here, bouncing higher and finding that support around this $40 level. I think that you're looking at a target of about 48 to the upside. If we break out above 48, that would really accelerate potential upside here. So this company grows at a more, I would say, steady 17% year over year revenue growth. Um, it is also expensive at 19 times next year's sales, a little cheaper than the other ones, but also has a slightly lower revenue growth. And I think that's part of why it trades at a slightly lower multiple. But when we look at their subscription rates, their annualized reoccurring revenue, this is something that's continuing to accelerate. This shows us that they're doing better at retaining clients and upselling clients. This is really one of the major things that we look at when we look at these cloud computing companies is, are they accelerating their upsells? Meaning, are they selling more to their existing customers, and how fast are they bringing in new customers, specifically larger customers? And because these companies are still very early days, but most of these companies operate in verticals where there are not a lot of other competitors, at least not publicly traded companies that are competitors. So you have a fairly diverse subsectors, if you will, that you can invest in. I think because of how expensive these companies are, I don't particularly love trying to pick one specific vertical that I think is going to do best. I think that as investors, you want to be kind of diversified across these types of plays, because the type of play is virtual are very similar. It's just different verticals that they've kind of specialized in is different. So I think investment in this particular type of company deserves a more diversified view, instead of picking between Viva, Duck Creek Technologies or Encino. Just perhaps looking at all three in your portfolio, and diversifying across it, so you're not risking, or you're not putting all of your risk into one specific vertical or one specific company that is executing in that specific vertical. And lastly, I want to talk a little bit about communications as a service. Now, this is really where, as we dug into this, we could not believe how expansive communications as a service was, because on the surface you think companies like Zoom, communications as a service, but as we start to look into what the pandemic has done to consumer spending habits, our online consumer habits have changed substantially, and as a result of that, our expectation of how we communicate with the companies that we buy our products with have shifted as well. And there are so many applications of cloud computing to allow these companies to shift towards a more e-commerce based play. And some of the less obvious communications as a service services companies comes from what we call customer service as a service. So how to digitize customer service experiences, marketing, digitizing the whole marketing workflow for a company, because now they have to market not just across online and in store, but they have to market across many different channels, through e-commerce, through email, through social media, through text, through all these different channels, and the different cloud computing companies that power all of this, and then just the sheer e-commerce side of things as well. How do you actually manage an e-commerce, or a very diverse e-commerce business? There are so many different communications as a service companies, and this is really, in my opinion, another subsector that is very early days. And there are some very interesting companies emerging from this particular subsector, if you will, that I want to walk you through. But like I said, this is really the subsector where we're just scratching the surface. So with each company that I'm going to talk about, I'm also going to show you some of their peers or some of their competitors that I didn't have a chance to talk about here today, or else this would go on for 3 more hours, just to give you a sense for the players, right? So the biggest one that we typically think of is Salesforce, in terms of communications as a service. So And 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 as a consumer, we don't think of Salesforce as a communications company, but as an enterprise company that serves a wide, diverse group of consumers or customers. Salesforce is really the backbone of any enterprise customer relationship management, and they were the first mover in this particular space. Uh, the CEO had this vision of creating a cloud CRM service where basically everything you needed from a CRM system was managed by them. All you have to, as a company, need to manage is the applications, and Salesforce took care of everything else in terms of hosting that and distributing it across your entire workforce. So that's why Salesforce is the number one player and remains the number one player. It is a stock that we currently have in our portfolio. It is one that, after having what has been a very challenging year, has started to break out here to the upside. And this is part of why we have a long position here in Salesforce right now, is because of this recent breakout after what has been a very long consolidation period. So the business looks very strong, 23% year over year growth, despite being the number one dominant player in this particular space by far. Their market share continues to grow. They're the only firm in this particular, and the CRM space, I would say, is extremely fragmented. There are a lot of small players, but Salesforce is by far the number one. They own about 1/3 of the market share right now. And like I said, they really just provide this environment that allows companies to build out their CRM within the Salesforce cloud computing a platform, and distributes it to every single person in the organization that needs access to it. It pulls in data from all sources of the organization, processes it, and provides the data and analytics, and manages every single customer through their platform. And recently, their acquisition of Slack really just sits on top of the Salesforce's application layer and allows the entire organization to communicate within Salesforce. So there is really no there are plenty of alternatives to Salesforce, but there's a reason that all of the major Fortune 500 companies use Salesforce as their CRM. And there is really no one that competes with them from an enterprise perspective. There are plenty of competitors on the small and medium business perspective, and that's really where the spaces are extremely fragmented. The closest thing to Salesforce as a competitor is Adobe, and we usually don't think of Adobe as a cloud company, but it really actually quite, it is actually an interesting company from the perspective of Adobe has made this huge shift over the past 5 years or so to move away from selling single license softwares for all of their services to more of a subscription-based business, basically the same model that Microsoft had with Office 365. But Adobe also bought Magento a few years ago, a major player in the online e-commerce CRM space. So that was their way of trying to compete with Salesforce. Magento is still a small player, but and more so focused on medium-sized businesses rather than enterprise clients like Salesforce does. But this is really, some of the type of companies that are competing in this particular space. Shopify also as well, and Hubs, a smaller CRM system, again, focused more on small and medium-sized businesses, worth paying attention to because no one competes with Salesforce on the enterprise side, but in the medium-sized businesses, Adobe, Shopify, and Hubs competes fairly strongly against each other in this particular space. So worth looking into, especially some of the smaller players or players that focus more on small and medium businesses. But Salesforce, certainly belongs, in my opinion, in your portfolio for looking at communications as a service, the number one player. The next one, which is probably very obvious, is Zoom video communications. And I think, I've been a huge proponent of Zoom. I've been using the platform since 2017 or 18 or so. I talked about the stock on CNBC when it was at $100. I had no idea the stock was going to rally up to $560. And over the past year or so, a lot of consumers and investors have effectively written Zoom off as kind of a fad during the pandemic. That's just going to continue moving lower here into this back into kind of where it was trading before. And this is really where I think it warrants taking another look. And I had written this company off for a little bit as well, but as we start to look at some of the underlying fundamentals and some of the numbers here, and also looking at the vision that Zoom has, I do think that it's worth taking a look at again. Zoom obviously powered most of the work that we have been doing from home over the past year or so. Certainly the first leader advantage, if you will. Zoom is now a verb as opposed to just a software that we use. So they were the first cloud native communications platform for video. There are plenty of other players now in this particular space, and that's part of why I think a lot of investors have started to write Zoom off, right? Just the fact that you have companies like RingCentral, Cisco, Citrix Systems, Microsoft Teams that are now competing in this particular space, and it feels like a very commoditized service that Zoom can't really differentiate themselves from any of these other players, right? And largely, I would say that that is a fairly real risk, if you will, to Zoom. But right now, Zoom has now 500,000 paid accounts for Zoom, and that is something that continues to actually grow at a fairly substantial pace. And we have actually not seen a slowdown in terms of the number of new accounts that they're opening with paid accounts to Zoom. And this really provides what I consider as a very strong foundation for upsells and new products. Zoom right now predominantly has two main products, which is Zoom Phone, which is a voice over IP solution for both landline and mobile, and Zoom Rooms, which is an enterprise level video communications platform for virtual conference rooms. And I think that's really just scratching the surface of what Zoom wants to do with respect to video communications, in terms of being able to provide services on top of the video communications platform that they've provided. And they've just, the numbers just continue to actually improve rather than erode that we were expecting. 43% of new revenue came from upsells of existing accounts, and they've been accelerating the number of enterprise accounts. And enterprise accounts are companies that pay over $100,000 a month to Zoom for their services. So for those reasons, I do think it's worth taking a look at this company here again, especially as the valuations have come down from those peaks. And as long as they continue to accelerate some of these metrics that are important, like I said, for cloud computing is upsells, number of accounts, and especially as they continue to build out new products, Zoom has differentiated themselves from the other players, which, like I said, RingCentral, Cisco, Citrix Systems, even Microsoft Teams. Obviously, Microsoft's revenue from Teams is very, very small compared to their other businesses. But if you look at RingCentral, Cisco, and Citrix Systems, those are primary video communications platforms where Zoom, I do think, has a leg up and a differentiator because they do stand out from that particular space. So worth paying attention to, but also a lot of other players in this particular space. The next one I want to talk about is Twilio. This is one that we have covered before, but it is still a relatively small company, $1.7 billion in revenue last year. What's really interesting about Twilio is that they are really one of the few players in their particular space, which is communications as a service. So as a business, if you want to communicate with your clients over email, you have an email server or perhaps an email software for that. But if you want to communicate with your clients over text, over WhatsApp, over SMS, Twilio is really the company that powers all of that. They have APIs that allow a developer to ping an API and be able to send out a group text and be able to receive that message back into their CRM system. they are the technology facilitator between your company's internal CRM system and the text messaging platform, WhatsApp, Skype, whatever communications platform that your customer prefers to contact you with. They are the middleman, if you will, that funnels all of those communication channels into one unified CRM system for your company. And this has revolutionized the way companies can interact with their customers, especially broad brands, like if we think about brands that everyone consumes, like Nike, Apple, these types of brands that want to be able to allow their customers to communicate with them across pretty much any possible medium that the customer prefers to communicate with, and be able to have a single source of communication on the clients, on the company side, because you don't want your customer service agent to be on text 1 minute, and then on WhatsApp the next minute, and then on social media the next minute. You want them on one platform where all of their all the messaging from a customer goes into one unified place. And Twilio is really the company that powers that. It is quite revolutionary in terms of what they provide. They have very strong revenue growth, 43% revenue growth in 2021. They are very expensive at 25 times next year's sales. But I do think that the company is fairly innovative, recently pulling back a little, and perhaps starting to break out here after what has been a 3-4 month consolidation period, and is now starting to break out here. So looking at this chart pattern here, you have the strong breakout here, a consolidation, and now a new breakout that projects substantially higher. And their recent acquisition of ZipWhip, which is something that's very interesting, it now enables messaging to customers over toll-free numbers. So imagine you used to call, Delta Airlines or American Airlines on an 800 toll-free number. Now they can communicate to you through text over those toll-free numbers. It really has changed the way that enterprise companies can communicate with end clients here. So this is a company that still is expecting to see a fair amount of revenue growth going forward. It's not on everyone's radar, but it is, I think, on a lot of cloud computing radars right now. But I still think that this is one of the most innovative companies that we have researched here for today. Another one I want to pay attention to here are really the communications, right? This is really one that sort of competes a bit with Zoom, but is more on the contact center side. So we think of Zoom as a facilitation of communications internally within a company, but a lot of companies need that same type of communication with end clients or customers. And 8x8 is just an example of a company that provides these types of communications platforms for call centers or contact centers. So think about your sales reps, think about your customer service reps, the communications platforms that they have or unified communication platforms that they have to talk to customers across all of these different types of mediums. A company like 8x8, which is actually, surprisingly, when I did some research, has been around since, I think, 1997. Never heard of this company before. They do about $500 million in revenue, and there's a few other players. FIVN is one of the other ones that compete with them. Revenue growth is slowing down for this type of company to about 14%. This is a type of company that I do find hard to differentiate from each other, right? Providing a unified communications platform. It's hard to differentiate 8x8 with FINV, with Zoom, with some of the other companies. I think for those reasons, that's why it trades at a much lower valuation. It commands only a 6 times multiple of next year's sales, despite a fairly decent revenue growth. I think it's because investors do not see these companies growing their market share substantially from here. They really just see these as companies that are growing with the market, but not really differentiating themselves and really able to compete and take market share from their other customers. But it's very interesting to see, if any of these companies do emerge as kind of a leader in this particular space, because call centers, are very, many times use different technologies. They have one system for phone, they have one system for chat, they have another system for email tickets. Companies like 8x8 unify all of that into a single platform for that customer service agent. And lastly, another thing that is kind of relatively new as a result of the pandemic and this huge shift that we've seen to e-commerce is really managing the experience for your customers and your employees. So Qualtrics is a leader in this particular space. This was a company that IPO'd just this year. They do about $763 million last year, so fairly sizable company. This is a fairly international company. They have offices pretty much, I think, on every continent the last time I looked. They provide services similar to what SurveyMonkey has provided, but they do a little better from a cloud-based experience perspective to effectively monitor client experiences and provide a unified platform that allows businesses to understand their customers' experiences, their employee experiences, and have it all in a unified system that they can use to build automation from. So if they find that their customers are not satisfied, they can build automation to try to rectify that without having to have a human being involved, if you will, and just have constant and real-time monitoring of just the experiences that their customers are having, good or bad, and being able to adapt to it. This is a fairly new segment of the market that has not existed before this huge shift to e-commerce, because we've never really had to survey, if you will, customers in real time and have an understanding as to whether they're having a good experience or not. And the companies that are able to provide customers with instant feedback if they're having a good or a bad experience are really the ones that are going to grow as an e-commerce business. And this is really one thing that's interesting, because you have a lot of small online brands over the past few years that have been able to grow very, very strongly due to having these very strong user experience user experience automation, if you will. And then you see these large brands, large enterprise brands that have really fallen off the map because they have not invested in this type of technology to have access to real-time information of their clients and be able to respond when their clients are not happy or customers are not happy. So Qualtrics is really a leader in being able to differentiate some or allowing to boost some small brands into kind of mainstream, and at the same time, big mainstream brands that have not kept up have really taken a huge shift, a huge toll, if you will. Think about some major names like Macy's, like Nordstrom's, that have JCPenney. Well, JCPenney's been struggling for a long time, but big names that have really fallen during the pandemic that should have been able to accelerate their sales because they were very strong brands, but have fallen because they didn't invest in this type of stuff. And this is really where XM Qualtrics has revolutionized this. Trading at 18 times next year's sales, a strong revenue growth at about 21% revenue growth year over year for next year. And what's interesting about Qualtrics is that SAP, the large European company, has a controlling stake in Qualtrics, and they are able to upsell their services to the roughly 400,000 customers that SAP has. So they have a fairly sizable leg up, in my opinion, of what you would consider a startup, but having access to a Salesforce and a customer base of a much, much larger enterprise company. There are quite a few competitors in this particular space as well. MDLA, Zendesk, and HubSpot also all compete in this particular space, but I think Qualtrics does stand out in their ability to differentiate themselves in this particular space. Brand new company. As you can see, the stock hasn't performed very well since the IPO, but it seemingly has found a bit of a bottom here around $32 or so, looking for that upside towards 42. If it can break out above 42, which is also the price that it started trading at the IPO, that's really where I think the potential upside is substantially larger here for a company like Qualtrics. With that, that covers what I wanted to share with you here today. Like I said, I had a lot to share with you. And even then, this is really just scratching the surface. And this was meant to give you a sense for just how many different types of companies are out there positioning themselves using cloud-based technology to differentiate and disrupt certain industries. And when I thought about working from home, I was thinking about companies like Zoom and Microsoft that powered this. When we dug into it, there was so much more behind it. And I hope that this gives you a sense for just how deep this really runs and how many more opportunities we really see as a result of the trends that have emerged from us working from home and shifting all of our habits to more online based spending. So with that, like I said, thank you so much for your time here today. What I'll do is I'll post this with the recording to our YouTube channel here in in an hour or so that you can review this at your own time. We'll also send the slides out to you so you can see the type of companies, the metrics behind each one, the businesses they're in, as well as the peers, so that if you want to do some research within the other types of companies, you can go ahead and do so at your own time. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week on Tuesday morning for our Tuesday morning market outlook session. And next week we have some great sessions. I have a session with Michael Coe on trading oil futures. And then I hope for some of you, if you missed last night's session on growing growing an options trading account, I highly recommend, if you missed last night's session, to please go back and watch that recording, because I still think it is probably the most important lesson for any trader to learn, is proper psychology around managing risk. So I really enjoyed doing that session last night. I hope some of you were able to join, but for those of you that were not able to join last night, highly recommend you to go back and watch that session. With that, thank you so much. Have a great trading day, and I'll see you guys here on Tuesday.